Hey guys, it's me Nicolette Mashile, also known as the Financial Bunny. On this video, I'm going to talk about how the interest rate cuts can be beneficial for you and I as the consumer. So let's start here. What does it mean when they cut the interest rates? Well, basically what it means is that the Reserve Bank has cut the rate at which they lend money to the commercial banks. So that obviously has a trickling effect down to us, the consumer, because remember, we do not borrow money from the Reserve Bank, but we borrow our money from the actual commercial banks, right? So the commercial banks have what is called a prime lending rate. If you are a consumer with a great credit rating and you've got a good credit score, you generally will get the prime lending rate with maybe +1 or -1, whichever way it moves in your direction and how the bank feels about or how the bank's credit lending criteria is actually put together, right? So when the interest rate is cut, when the repo rate, which is the rate at which the Reserve Bank borrows the commercial banks, when that gets cut, it means that the banks have to also lower the prime lending rate that they lend to consumers, me and you, right? So when you took out your loan, if you were given an offer with a linked or variable rate, now in this context, linked and variable mean exactly the same thing. It means that your rate can fluctuate with what the economy is doing in South Africa. So when the repo rate gets cut, the prime lending rate goes lower. It means that your linked or variable rate will also fluctuate in the direction of the repo rate. So if the repo rate were to go up, the prime lending rate goes up, your rate that you've been offered by the bank will also go up. If the repo rate goes down, prime lending rate goes down, it means that you and I, who have the variable or linked rate, our interest rate will also go down. Now remember that the bank uses three things to calculate what is your monthly repayment on a specific loan. What they use is the loan term, so how many years they've given you to pay off a loan. They use the outstanding balance, which is actually the principal amount, right? And then also they use the interest rate that they've offered you. And together, they calculate how much you need to pay back every single month so that you pay back the principal amount plus the interest that they are charging you, right? So now when they decrease the repo rate, which decreases the prime lending rate, essentially you are changing one part of that formula that they use to calculate the repayment rate, right? So you're now lowering the interest rate. So it will make the repayment less than what you were paying before when the prime lending rate was still a little bit higher. Now, how do you work with this to make sure that it is beneficial for you? When they change the repo rate and the prime lending rate goes low, it means that you are going to pay less than what you paid the month before. Very important to remember. If you do not want to pay more interest overall, this is a great time for you to use those savings to actually start tackling the principal amount. So you're not only changing one area of the formula, you're now changing two areas of the formula. You're changing the outstanding balance, which is the amount that you actually borrowed. You're lowering that. You're lowering the interest rate. When the repayment comes back again, it's going to be lower interest that you pay overall, right? Now, that's the one way to work with it. So keep paying the same amount of money that you were paying the month before, because if you are able to, why not? Ultimately, what the benefits you're going to get from that is that you're going to finish off your loan faster and you're going to pay less overall in interest. Now, the second way you can use this is by taking again the difference of that money and allocating it to other dates and actually start finishing off those other dates. So using the snowball method, because what we always say about the snowball method is either find an additional income stream that's going to give you a little bit of extra money or find it somewhere in your budget. Now that specific loans will have a lower repayment, you can use that difference to be able to supplement other loans, right? The third thing you can do is to supplement your savings account with that difference. What we all know is that most of the banks use a debit order method to be able to collect their monthly repayments. So they're not going to collect the same amount of money that they had collected last month because they've adjusted the actual interest rate. So now they're going to collect a lowered repayment. So the difference, you will be able to see it because you have already budgeted. Use that money to actually allocate it now to your savings or to your investment vehicles. Last but not least, remember that in every financial crisis, there are opportunities. Remember, a financial crisis is simply a transferal of wealth from one group of people to another. So there will be assets that are going to be trading below their intrinsic value. When we talk about intrinsic value, we talk about their true value. A lot of people already started seeing it in the stock market and in the property market. So this is the time for you to keep your eyes peeled to the ground, Keep your ears nicely pricked up so that you can hear about any financial opportunities that are available, and you can allocate that difference that you are making, the little bit of savings you are making from, paying a lower repayment amount because the interest rate has been cut, to actually explore and take advantage of those opportunities. Mwah.